Welcome to Mind Your Money. I'm Julie Hyman, and this is Yahoo Finance's flagship personal finance show. Think of this as your financial toolbox. For the next 30 minutes, we'll give you the latest money news, cut through the jargon, and tap into expert advice, all designed to help you take control and build a stronger, healthier financial future. On today's show, some cities and states are rolling out welcome mats, offering pots of cash to lure remote workers. We'll reveal the locations. And personal finance essentials. Is it safe to link your bank accounts to financial tools and apps? We'll discuss. Plus, medical debt will not be taken off credit reports. We'll talk to an expert about how to avoid having your medical debt go to collections. Stay tuned. For fully remote workers able to work anywhere, listen up. Some states will pay just to have you as a full-time resident. Senior columnist Kerry Hannon joins me now with the details. Kerry, this is pretty incredible that these programs even exist.
Yeah, I think it's kind of exciting. The idea is some of these cities and towns are interested in getting, really bringing young professionals, or it doesn't have to be young necessarily, but getting new energy into their cities. And so they said, you know what, let's push forth. And well, some companies are saying, hey, we don't want remote workers. They're saying, come to us and we're going to pay you an incentive to come. And some of the places, Julie, that have come up are in West Virginia, in Kentucky, in Texarkana, Texas, Columbus, Georgia. I mean, they're all around the country. And it's the sort of incentives a range, but they can be, around $10,000, $12,000.
That is not nothing for sure. And actually, one of these locations, Kerry's offering more than just cash. So what can you tell us about the Tulsa Remote program?
Yeah, Tulsa Remote is one of that's really gotten up ahead of steam. They're sponsored by the George Kaiser Family Foundation. And to Tulsa, they offer not only a $10,000 incentive, but they'll help you find housing. They'll give you co-working space to work in, meetup groups. There's all kinds of sort of community building efforts because they really want to encourage people to stay and to be there and develop their own community. And they have a pretty good track record at this point. And so that's the one that I have really focused on. But there are several around the country that are popping up.
Yeah, really interesting stuff. Thank you, Kerry. Appreciate it. But you're going to stick with us. You'll be back for another edition of Ask Yahoo Finance Anything in just a bit. And you can scan the QR code to learn more about the cities and states offering cash to lure remote workers. The average salary in the U.S. in 2024 was around $60,000 a year, according to the Bureau of Labor Statistics. That means after taxes, you likely bring home around $3,800 per month, according to ADP. And Yahoo Finance personal finance editor Casey Bond is here to break down how someone with that salary can budget successfully. It's a very important question. Casey, if your take-home pay is just under that $4,000 a month as a single adult, how much should you be budgeting for necessities like housing, transportation, and food?
Sure. Well, as you can see, even though $60,000 a year is the national average, that really doesn't translate to a whole lot of money every month once you account for things like taxes and today's inflated costs. So these budget breakdowns are really based on an ideal scenario, but it's important to point out that budgets are very personal, and you should absolutely feel free to adjust these numbers to meet your specific needs. With that said, housing is generally the most expensive budget category for most people, and we recommend setting aside about a third of your budget for that. Food would be the next category at 15%. That includes things like groceries, dining out, ordering DoorDash, what have you. Next is transportation, which should be about 10% of your budget. That includes car maintenance, gas, public transportation, rideshare. And then things like utilities and healthcare should be around 5% of your budget.
What about savings? How does that factor into all of this?
Well, saving can be really tough, especially in today's economy, but it's also very important. So we recommend setting aside about 15% of your income towards savings and investments. That's going to include your emergency fund, saving for goals like going on vacation, and then very importantly, retirement savings. And we also recommend, if you can swing it, setting aside about 5% of your income in your checking account to act as a buffer. Overdraft fees are very expensive, so you don't want those eating into your hard-earned money. And then it also affords you a little bit more wiggle room if an expense does come up and you don't necessarily want to eat into that emergency fund.
Yeah, definitely important. So we said this was for a single adult. If you have a family, if you start to grow your family, how then does that change the budget?
Sure. Well, the nice thing about being a single adult is that your obligations are probably going to be a lot less than maybe later in your career when you do start a family. One expert we spoke to actually recommended aiming for as much as 50% of your income in savings, if that's something that you can afford to do. But once you do start a family, you maybe have a spouse or kids, your daily essentials are really going to increase. You might be in the thick of mortgage repayment, you might be paying for childcare, and then your savings also needs to increase. You might be paying towards a 529 plan for your kids' college. You're going to need a bigger emergency fund. So that really means you're going to have to dial back that discretionary spending. It's really about making sure that you can afford today's obligations and you're planning for the future.
And speaking of the future, Casey, how does all of this change when you retire?
Well, the good news is that once you're in retirement, generally your lifestyle costs are going to decrease compared to where they were when you were working. You may downsize your home or relocate. You're just not going to have those same expenses. So that means it's time to actually enjoy the fruits of your labor, and you can actually increase some of that discretionary spending. That's not to say that you shouldn't still have a really solid budget in place. There are other expenses that tend to pop up in retirement, particularly healthcare costs. But you can increase that discretionary spending, and you can dial back the savings too, because you're now living off of your investment income that you worked so hard to generate.
Yeah, makes sense. Thank you, Casey. Stay with me here, because the Federal Trade Commission found that Americans reported losing $12.5 billion to fraud in 2024, affecting over 2.5 million people. So you want to be careful before sharing your bank information with any apps or services. Yahoo Finance personal finance editor Casey Bond still with me to share some tips here. So Casey, what are you doing when you link your bank info to a payment service or app? What do we need to know about that?
Right. So whether you're using a budgeting app or a peer-to-peer payment service, or a digital wallet, linking your bank accounts means that you're allowing those two different platforms to share information with each other. What's interesting is that generally these platforms don't access your bank accounts directly. There's typically a middleman of sorts. Two platforms that are pretty popular are Plaid and Yodlee. And what these do is they take the information from your bank accounts, share that information with the financial services platform, and encrypt that data so that your username and account password and other sensitive information isn't actually stored within the platform.
And what are some signs? I mean, you mentioned a couple of names, but what are some signs you're dealing with a reputable service? And then what are some ways to keep your information safe?
Sure. Well, there's so many different tools and platforms out there. So it's really important, first of all, to check that there are a lot of user reviews and that they're generally positive. And then you want to investigate that platform's particular security measures. They should have things like encryption, multi-factor authentication, and then you want to ensure that you're not actually keeping money inside of those platforms. Say you use Venmo, for instance, the money in that account is not protected by the FDIC. So it's really important not to hold a lot of money within these platforms and always transfer it to your bank account.
Casey, what are some of the benefits of linking your accounts?
Well, obviously the biggest benefit is the convenience. If you need to pay back your friend, you don't need to pull out cash or write a check. You can just send them the money. It's also great for financial planning. If you're using a budgeting tool, it's going to pull in that information, categorize everything for you. It's going to be a lot more accurate and less time consuming, so you can make really informed financial decisions without a lot of work.
And how about the risks of doing it?
Sure. Well, a lot of these platforms do have really robust security measures in place. There's always that risk of a security breach or fraud. So again, it's really important to investigate a platform before you decide to use it and connect your bank accounts. Ensure that they have those really robust security measures in place. And then you also want to avoid things like using public Wi-Fi. That just makes you a little bit more susceptible to hacking. And also make sure that your phone is password protected.
Man, I got to remember that public Wi-Fi one. I am guilty of that on occasion. Casey, thank you so much. Appreciate it. And you can scan the QR code below for more banking content from Yahoo Finance. President Trump signing an executive order that opens the door for retirement savers to invest in alternative assets like crypto and private equity within their 401k plans. The Labor Department and the Securities and Exchange Commission will now revisit and update rules clarifying what is allowed in 401ks and other contribution plans and issue guidance to employers about these assets. Private assets have not typically been in 401ks due to some of the risks associated with the investment, such as higher fees, lack of transparency, and longer lockup periods. But backers of the plan say private assets offer diversification and the chance for higher returns over time. This executive order is just a first step in making alternative assets more common in retirement accounts, but the transition is already underway. Back in May, retirement plan provider Empower said it is joining other asset managers like Apollo in allowing private assets in some accounts later this year. And in June, BlackRock announced it's launching a 401k target date fund in the first half of 2026 that allows an allocation to private investments. What will this mean for you and your retirement plan? We'll have more coverage of this in next week's Mind Your Money and have experts lay out the pros and the cons. Coming up, a Biden-era rule that would have stopped medical bills from appearing on credit reports has been blocked. We'll give you expert advice about how to keep medical debt out of collections and ideally off your credit report. Stay tuned. A judge has blocked a Biden-era ban on medical debt in credit reports. Now, technically, the rule from the Consumer Financial Protection Bureau never took effect, but if it had, it would have stopped medical bills from appearing on credit reports and barred lenders from using that data to make lending decisions. The CFPB says removing medical bill information could have wiped $49 billion off credit reports of about 15 million Americans and increased their credit scores by an average of 20 points. But a judge ruled in favor of two trade associations that argued the CFPB overstepped its authority in issuing that rule. This comes at a precarious time in healthcare, with millions of Americans expected to lose health insurance by 2034 due to changes in Medicaid under President Trump's new tax bill. So how does medical debt and your credit report work without this rule? Say you get medical care. The provider will send your bill to insurance, and you're responsible for whatever your insurance does not cover. If you don't pay that balance, the provider will likely send you reminders. If you still don't pay, they may send that debt to a collection agency. Once it's with the agency, they own that debt. They'll start calling and sending you letters, and they may report it to credit bureaus. Once reported, it can appear on your credit report. Now, it may not hurt your credit score right away. Medical debt must be 1 year old before it shows up on your credit report. Debt under $500 is not reported. And 14 states have provisions in place to remove medical collection debt from credit reports. But still, consumers are left with the responsibility to stay on top of changes to their credit as they face mounting bills. So let's talk about the actionable steps you can take to keep medical debt out of collections. Here with more, Kristen Schell, Chief Program Officer at Working Credit. Kristen, thanks for being here. Walk us through what you should do when you first get that medical bill in the mail.
Sure. So first, I would recommend opening the bill. It's human nature to want to ignore it, put it aside and wait for later, but it's really important to open the bill and look at it. I would then scan for any inaccuracies. There are many inaccurate information on medical bills, and so it's important for you to look through it. Look at the explanation of benefits from your insurance company, and then talk to the medical provider as well, even requesting an itemized expense list to make sure that everything is accurate.
This seems so obvious, and yet I have been guilty of this so many times where I just throw it on the pile and forget about it until I feel like I need to, and sometimes it's too late. So let's talk about what happens next. Presuming everything is correct there, give us some options for people who may have trouble paying that bill.
Absolutely, and you do have options. The first option I would say is to call up the hospital or the medical provider and ask if they provide financial assistance or charity care. Many do, and many are required to provide financial assistance. And so it's important to see if you can qualify. You do need to know that you have about a 240-day window to check to see if you qualify for that financial assistance. If you are outside of that 240-day window, I would still look to see if you qualify for financial assistance. There is a great nonprofit organization called $4 that does help individuals walk through that financial assistance application for each individual hospital. If you don't qualify for financial assistance, you still have other options. One is going to be to talk to the hospital or the medical provider and see if they'll negotiate a payment with you. So let's say you owe $200 bill, a medical bill, they might settle that or negotiate that for $150. You would need to bring it in a lump sum, so they're not going to do a payment plan on that negotiation, but many medical providers will negotiate a medical bill. And then lastly, you could also always do a payment plan. And even a $5 or $10 monthly payment plan may keep you out of going into collections. It's just something that you're going to need to ask that hospital or medical provider.
And then, Kristen, in terms of some other best practices for medical bills, what about putting them on a credit card, for example? Why should you be careful of doing that?
Yeah, so I typically don't recommend putting a medical bill in onto a credit card. Now, if you're going to pay that credit card off in full as soon as you put it on and you want to get rewards or points, that's fine. But if you're going to put a medical bill onto a credit card and then pay like the minimum payment over time, there's going to be two kind of issues with that. One, you're going to start to accrue interest, and credit card interest rates are at a very high right now, anywhere from about 25 to 30%. So that medical bill that was maybe $2,000 is now going to cost you a lot more money over time. The second is that there are protections that come with medical debt. As you stated, medical debt doesn't hit your credit report until it is 1 year old. If you put that on a credit card, you are now turning that medical debt into a consumer debt. If you default on that credit card and it goes into collections, that credit card debt is now going to hit your credit report and you lose that kind of medical debt protection.
So if you don't pay the bill and you get called by a collection agent, does that mean it's already on your credit report?
Yeah, that's such a great question. So just because it's in a collection agency is calling you, it does not mean it's on your credit report. Remember that collection can't hit your credit report until it's 1 year old. But a lot of times what happens is that the medical provider or hospital will try to collect on that debt for maybe 3 months or 4 months, maybe up to 6 months. But then after 6 months, they are going to send that to a collection agency, and the collection agency is going to try to collect that. And they have between that time period that they get it until it's 1 year old to then put it onto your credit report.
Gotcha. And then what if you pay your medical bill, but it's already gotten onto your credit report by the time you pay? Is that then sort of on your permanent record, so to speak?
Yeah. So another positive protection with medical debt is that if it does go into collections and it hits your credit report, but then you pay it, that collection will come off of your credit report like it never happened before. So it just is removed and you would not see it on your credit report anymore, and lenders wouldn't be able to see it. Unlike non-medical collections that stay on your credit report for 7 years, even if you do pay it.
So that's so interesting that medical debt is so unique. Kristen, appreciate it.
Thank you.
It's time now for our weekly segment, Ask Yahoo Finance Anything. And this week, we're zeroing in on medical costs. I'm joined by Yahoo Finance senior columnist Kerry Hannon back with us. So Kerry, let's jump right in. The first question says, I just signed up for traditional Medicare starting this fall. What can I expect to pay each month? So manage their expectations. What can they pay?
All right, I got to say up front, this stuff is not easy. This year, you're going to pay a premium. So for next year, it's going to go up, but for 2025, the premium is $185 a month. And you'll also have a deductible of $257, which is paid once, upfront once a year before your Medicare kicks in. So expect those will tick up a bit next year, but that's where you're going to be there. In addition, most people that have traditional Medicare also have a Medigap policy, which is a private health insurance policy that covers all the things that traditional Medicare might not, including the deductible and co-pays and so forth. These policies you buy separately, and they range, widely depending on your age and your health and so forth. But they can be anywhere from, $30 a month to $300 a month. So it's a wide gap. You really need to shop around for those. But most people also include that in their other things. I should also note that for the Medicare premium, the $185 I mentioned is the basic, but it can go up depending on your income. And they look back 2 years to what your income was 2 years prior to get that number. So those are some things to keep in mind. I would say you can go to Medicare.gov. The Plan Finder, Medicare Plan Finder, is a great resource to do research on what your individual situation might be, depending on where you live.
Okay, good to know. As you said, not easy. Question 2, I promise I did not put this one in here, but this relates to me. I am in my 40s. The question reads, how much should I have saved to cover healthcare costs in retirement, and what can help me save more?
Okay. All right. Well, take a breath. This is not a small number. Fidelity just recently came out with their projection for if someone were to retire this year at age 65, they could expect to spend $172,500 out of pocket for the remainder of their life. So figure you're 40 now. I'm telling you, healthcare costs are not going down. So this is a big chunk of change. And so it's really something that very few people plan for. What they think about how much I need to have saved for retirement, but how much do you need to have saved for your healthcare coverage? And most people say you should estimate 15% of your annual living costs should be devoted or will be devoted to your healthcare costs.
That is a good rule of thumb to remember. And lastly, someone asks, I'm struggling with caregiving for my mom and trying to get my job done. Is there any benefit that my employer might have or that I can ask for to help?
Yeah, this is super tricky. And believe me, I've been through this myself. The one thing, lots of employers can be flexible with you. You can talk to them about your situation and work for scheduling things. But the one thing that is available to many employees is the Family Medical Leave Act. And what that does is that gives you 12 weeks of unpaid leave from your company, but your job is protected. And what that might just be enough time for you to not be worried about losing your job, but to figure out how you're going to make this work for you. I'm not saying it's a great solution, but it is a big help for people who have access to that. And Julie, I want to say one quick thing about the Medicare, how much you might expect, not Medicare, but how much in health insurance payments you should set aside, $172,500. That does not include long-term care costs, and about 80% of people will need long-term care costs. And so that, trust me, the number is going to be much bigger.
Yeah, very, very important caveat, as I am seeing firsthand, Kerry. Thank you so much. Appreciate it.
Thanks.
That's it for Mind Your Money. Scan the QR code below to sign up for the Mind Your Money newsletter, and stay tuned for Market Domination coming up next.
Are you ready to master the markets and, dare I say, become a better investor in the process? Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.